I think last time I did one of these, I was right before the drinks. Now we're two before the drinks, so I think that's going to be better. Let's do a few introductions. I'll kick off. Jeremy Sewell. I co-run a service and investment firm called Vault Partners. We service growth companies and investors, mandates across the spectrum, but with an indexation in the digital asset space. Matt, do you want to follow on, please?
Yeah, thank you. My name's Matt Schultz. I'm the co-founder and executive chairman of CleanSpark. We're the second largest Bitcoin miner in the world by hash rate, but we have the most hash rate in the United States of America. We pivoted from distributed energy resources, building microgrids and decentralized power systems into traditional data centers and evolved that into Bitcoin. So unlike most of my peers, instead of pivoting data centers to Bitcoin, or excuse me, Bitcoin miners to data centers, we fired all of our data center customers and pivoted to Bitcoin. So,
and our story's a little different. I'm Jeff Lucas. I'm the CFO for Bitfarms. We have about 500 megawatts, approximately 20 exahash. We're in 4 countries right now: Canada, the United States, Paraguay, and Argentina. You just got a summary of our operations here from Ben Gagnon, my colleague here. We are indeed actually sort of pivoting over to HPC, and we'll talk about some of the compelling elements behind that thesis very shortly.
I'm very honored that Matt said we're peers, because I think he's 2 feet taller than me. So, my name's Manash. I'm the CFO of Synteq Digital. We are a data service provider for solutions, primarily to the Bitcoin mining industry. We've had multi-decades years of experience servicing that group. Work with both public miners as well as the private miners, so we can bring some perspective on what we're seeing in the markets there. And then most recently, we've started to pivot into HPC AI servicing as well. We acquired a company in the US called Crunchbit. They have 7 data centers that are operating, so we have a little bit of experience there now, so just happy to be here.
Thanks, guys. So I think this session's going to be fun for 2 key reasons. One, in prepping for this, these guys said, ask what you want, nothing off limits. I think that's right, yeah.
Matt said that, by the way. Just
did he say that? Second part, I prepared some questions and then lost my glasses, so I can't read them. So let's do a little bit of setup. And we had an HPC presentation immediately before this, and we're going to talk about the future of Bitcoin mining. But if you've been here for 2 days, I think you'll realize you can't really talk about one without the other. And I've been in the space for about 8 years. I was CFO of a company called Bitfury, some of you may have heard of. I was part of the founding team of Hashrate. So I've seen a lot of change, but it's starting to sound a little bit negative. We're in a sector where we kind of have 2 halvings of profitability every 4 years. One you all heard of, where you cut the emission of Bitcoin. The other one people focus on less is a doubling of hash rate. That's pretty unique. And we're kind of in a part of the cycle where we're not far off a low in hash price at about 5.5 cents. But even now, you've got the leading miners, these guys and their peers. Some of these guys are still at a 75% gross margin, and that's without the kind of uplift in Bitcoin price that I think everybody expects to see this year. So let's unpack this a little bit and start perhaps with some network economics. Let's start with you, if I may, Matt. What's going to happen in your view to the server and ASIC market, which is efficiency of miners is going to be a big part of this, form factor, how we call these machines. How do you see this evolving?
A year ago when we were sitting on this panel, a lot of the miners were talking about increasing efficiency from the 30 joule per terahash range, or 30 watts to process 1 terahash of data, down to the 20 range. And now most of the big miners are at or below that 20 range. And so I think, obviously driving efficiency of the fleet is going to be critical, but as you've heard throughout the day, I mean, Jeff's peer, Ben, said earlier today, they've completed their Bitcoin build-out. And many of our other peers have talked about the fact that they're pulling back on their guidance for growth and focusing more on HPC AI. So as you mentioned, difficulty is a big challenge. This is a cannibalistic business. The more successful we are, the faster we grow, the harder it gets to do our job. So for CleanSpark to remain as what we believe to be the only remaining pure play miner, that gives us somewhat of an advantage as institutional capital starts to look at exposure to the space in a manner different from just a Bitcoin proxy like an ETF. It gives leveraged exposure to a company that, as you said, has margins in the high double digits. So, I think focusing on the efficiency of the fleet is very important, but what's been kind of an overarching priority of our team at CleanSpark is the efficiency in which we run our operations. So we're, I think, the second most efficient fleet of all the major miners, but by far and away we have the highest uptime. And that's a result of the human capital investment that we've made. We've secured not only the right people and the right equipment, the right infrastructure, the right power contracts, but we've grown by adding our own repair facilities on site. We do repairs all the way down to the chip level. So everything we do kind of harkens back to our early energy days where it's about squeezing every last drop of efficiency out of the project, be it energy, data, or Bitcoin.
And I guess, Manash, you guys, broker a lot of the equipment deals in this space, I'm sure, with these guys and a lot of their peers. I guess 2 points. One, let's say 2 years from now, we're getting close to the next halving. Where do you see, the efficiency being of the key ASIC market? Plus, let's layer in some of the near-term challenges in equipment purchasing around tariffs in the US, which hopefully won't be here in 2 years, but they're here now. Any thoughts?
Well, I guess on the tariffs, that was an interesting day when those tariffs came out. We were in Northeast US visiting a site, and our phones just started going off the hook, and we're like, what's going on? And just customers calling in saying, do you have any devices? Do you have any, what's your supply like? We have units in other parts of the world. How do we get them here? What should we do? And it was like, if you've seen that movie, Planes, Trains, and Automobiles, it was literally just go planes, barges, boats, like whatever it was. And I feel like there was a rush to get equipment in because no one knew what the rules are and what they were going to be. I think that's calmed down a bit right now. But we were seeing things like shipments coming through different ports 1 week or 1 day, they'll be allowed through. And all of a sudden the next day, they're not. And there's no rhyme or reason. I think now that with the tariffs down to about, 10% and so from certain places that we're seeing things move. So, give you some sense, back half of last year, we did about 10 exahash of sales of equipment combined. In the first 5 months of this year, we haven't seen a slowdown in activity. So we've done about, close to 40 or so of exahash. So demand seems to be robust right now. I think people are going to buy equipment, right? It really depends. Matt was speaking about operational excellence, but really operational excellence, power, having low-cost power, and just having the ability to execute. There's people out there that can do that, and I don't know the power prices for every one of our customers, but there's obviously people out there that can make it work. Now going out further, thinking about the market, and you're right, halving and hash rate difficulty, but I do believe that mining will exist. I don't think mining is going to stop. It just might be a little bit different. And maybe I'll pause there. I have some comments, but I think I'm not bearish on the sector in terms of mining going away per se. I think it just might be a little bit different. So
I guess that's a neat intro into the cost of power. I think we've heard, if you guys attended some of the other sessions, we heard from Fred earlier, and I've heard others talking about this a lot, that in the Bitcoin mining world of the future, we're going to need to see power costs trending to zero, or we're going to need to see, strategies that, again, Fred was selling us earlier in terms of how we co-locate or partner with AI, in terms of how power is procured and how you can mine profitably in all conditions, up markets and down markets. Jeff, you guys are heavily into HPC, as we just heard from Ben. What are your thoughts on this?
Well, actually, I'm listening to Matt and listening to Manash's comments here, and I'm reflecting upon our sort of investment theses for the audience here. And we actually have really three compelling theses here that are built not just on the cost of power, but the operational excellence that Matt spoke to. And if you step back for just a minute and think about what are the elements that we're all striving here for that make an investment attractive. One is, of course, you want growing revenues and the quality of those revenues. Secondly, you want the expanding margins, and power certainly and operational excellence come into play there. Thirdly, you want valuation appreciation. As Ben spoke previously here, mining companies trade anywhere maybe 2 to 5 times multiples, and there are other sectors such as HPC which can trade 20 and even north of 20 times multiples here. What makes, I think, each of us having an interesting argument here and a compelling investment thesis is, on the one hand, when you look at what happens with the Bitcoin industry and the mining industry overall, in the earlier years, all that mattered was growth. Growth at all costs, the rising tide lifts all boats. As the industry is maturing here, costs become increasingly important, not only getting low-cost power, but even more important than getting those efficiencies that Matt spoke to and that Manash sells. And that's absolutely critical for the industry. And you look at where we are now here, and what's become very clear in any commodity industry, ourselves included, is that the largest players are going to enjoy the greatest cost advantage. And I think Matt pointed that out. They're in a position here, where they have they generate so many Bitcoin that their overhead and fixed costs can get spread over a larger number of Bitcoin. They've got pretty cheap, efficient power at their disposal. They're able to invest continually in new and the most efficient miners. And you've got a very steep technology curve in our industry here. That works in Manash's favor. When you reflect, as anyone here from the States, the California gold rush of 1849, they're saying the guys who made the money were the hardware stores, the ones selling the picks and axes. And as we're continuing to have to invest in miners here, that puts you in the catbird seat. You also enjoy a tremendous advantage, Matt, because you have a relatively low cost of capital by virtue of your size. We took a look at our situation and we recognized we have certain strengths, we have certain sustainable differentiations that don't necessarily apply as much to Bitcoin mining, but truly can apply to HPC. And when you think about the benefits of HPC here, first of all, you've got a fundamental demand there that's very consistent. So the quality of those revenues is getting higher. You've got counterparties like AWS and the hyperscalers and others, which make it very, very attractive from an investor standpoint. Secondly, here you get much higher margins because there is so much greater demand here. And the other point, you have stability and consistency of the earning stream, all elements that also make HPC very attractive. So you've got a very compelling argument, if I may take a few words out of your mouth here, from for what CleanSpark does here, for those who believe in continuing the growth of Bitcoin mining here and have the leadership position. You've got Manash's position here because he really enjoys the benefit of being able to sell and take advantage of that very steep technology curve as you continually have to invest in new miners. We're in the position here that we see a lot of fundamental potential and demand and opportunity here in HPC, and with the recent acquisition we made of Stronghold Digital Mining, one of the largest public acquisitions actually to date in our sector here, we've got some outstanding properties that are ideally suitable to help us manage our power far more effectively for what's going on, I think, certainly in HPC here. So I sort of give you a broad answer to your question here, but I think certainly power is critically important. Even more important is the cost of electricity per Bitcoin, the advantages that some of us enjoy. And furthermore, the cost of power is an important issue, but not the central issue, as the quality of that power for those of us going into HPC.
Great. Thank you, Jeff. Just a heads up, I will try and save time to come to the audience for questions, because I suspect your questions are better than mine. So think of that. But a quick straw poll question. Hands up if you understand the economics of Bitcoin mining or think you understand it broadly, a little bit. Okay, that's not bad. So I think the next question I think is the one that hopefully a lot of you guys would want to ask if you're up here in my position, based on what Jeff's just talking about. There seems to be an inevitability that all Bitcoin miners will pivot into HPC, but we've got one of the largest Bitcoin miners on the stage who are not pivoting into HPC. Tell us why not, Matt.
Well, it really comes down to the fact that we, of all of our peers, we were one of the originals that actually evolved into Bitcoin mining from data centers. And understanding the way that MSAs and contracts work and the requirements for uptime, even in a co-location hosted relationship, there are some more risks. Additionally, I don't have a customer. I don't have to sell anything to anyone. The Bitcoin network is there and it's always been there. And lastly, we've been fortunate enough to build a model. We have 32 data centers spread throughout the United States. And many of these data centers are in rural towns that 40 and 50 years ago, when the macro grid was laid out, there were manufacturing facilities and mining facilities and timber mills that were budgeted power, and the infrastructure to deliver the power to these locations was constructed. And then as many things or like many things in the United States, we offshored a lot of these manufacturing jobs and manufacturing facilities. So there are these small towns with pockets of power, 200 megawatts in Sandersville, Georgia, or 50 megawatts in a small location in Wyoming. But these aren't ideal candidates for an AI HPC conversion because the distance away from a major metropolitan area increases the latency. So the likelihood or the appetite for these to pivot to AI HPC is more edge compute type stuff. And so we've been fortunate that with the repeatability of our model, we can negotiate and work with these small communities where we can be that interruptible load that we understood from our power background and history in the energy business. We can curtail in the event of a storm, in the event of an unusually warm or cold weather incidents. And in exchange for that, we get favorable power. And like many of the panelists have heard today, everyone is facing this massive arms race. That it's not a race for a number of different things, as Ben mentioned earlier. It's a race for power. People are raising their hand. I've got 50 megawatts here, or I've got a gigawatt there. Our approach, by partnering with the communities, we buy power from them at their cost and allow them to make a margin on each kilowatt. So we're truly partners. What that does is it doesn't put the community at risk. There's no hedged instrument, or I don't pay for a financial tool to buy the power down. I get favorable market-based rates, and we make a real-time decision whether to underclock, overclock, speed up our machines, curtail our machines, and then we partner with the utility in the event of a black swan event. So what that's done, the result is these communities have been able to spend more money on bike paths and splash pads and walking trails and schools and infrastructure. And then the sales tax generated from the purchase of the utilities in most of our jurisdictions stays within those communities. And in Atlanta, they did a news story that the surplus sales tax in one of these small towns was so great that they reallocated it to pay down the property tax in that area. What that means is, instead of fighting for megawatts in areas around the country, we have a desk at our headquarters in Las Vegas receiving inbound inquiries for rural municipalities that have surplus power that are looking for ways to monetize those megawatts. So we don't have the same challenges that many of our peers do, and being interruptible and being flexible like the Bitcoin network allows us to do, we can be the ideal partner. In the event of a freak storm, we can curtail, push all that power back, and ensure that there's certainty for mission critical infrastructure within the community. So we just see it as fundamentally a different approach. And then when you look at the economics, and I'll be quick on that, Jensen Huang said at WWT that once they started shipping Blackwells, it made hoppers almost impossible to give away. And when you look at how rapidly the improvements in chip efficiencies go to, what Manash does at Synteq, the advancement of AI, Jensen said on that same presentation on stage that they expect to cut Moore's Law in half for the next half dozen years. What that means is the fleet of equipment, if you're running a GPU as a service business, becomes obsolete once a year. And so the CapEx then changes entirely different. So for our perspective, not having a customer, hodling and holding on to all of the most valuable network or asset in the world, covering our OpEx out of our sales, and having the most efficient fleet in the world while partnering with rural communities to strengthen the grid just seems to be common sense for what we do.
Matt, when you talked about power, it just triggered something in my head. So going back to, you were saying what happened when the UF tariffs came out, we actually got calls from Americans and other folks about building power projects in Canada. And we're like, Canada? Because it hasn't been the best of climates in terms of the government encouraging development. But if you think about what's up there, there's land. It's good for data centers. It's cold. Good for data centers. There's a good educating force. And I think there's a little bit of a, when we see down in the lower 51st, it's there's a bit of a struggle in terms of trying to find sites. And I think that people are starting to look other places as well, kind of. So that's kind of an interesting kind of what's going on in the power market. And the demand for machines, it's global, right? We're not like, we live in North America, the collective, not you, but us live in North America, but the demand's coming from other parts in the world as well. So there's some sovereigns in the Middle East, very different thought process about, mining Bitcoin, and very different thoughts about what type of machines they need. So we're seeing like older gen equipment being sold to certain areas, right? And it's economic for them. So to the point of what's going to happen to mining, I don't think it's going away. I think.
I agree with you.
Well, it's not going. It certainly is not going away here. But even with HPC AI, there are opportunities in remote locations. Part of our acquisition, we've got 2 properties in Pennsylvania here. One called Scrubgrass, and the other called Panther Creek. And these are communities that had heavy industry at one point in time. They no longer really do. They've got a lot of land. They're near fiber networks. They've got more than enough water. They're near, they're in the major urban cities, an hour and a half. They're close to campuses for a lot of the hyperscalers here. These are prime properties for development here. And the development and the investment in GPU is expensive. There's no doubt about it whatsoever. And the cycle is short, but so isn't the cycle short, I think, in Bitcoin mining as well here. And I think one of the benefits, actually, I would argue about HPC is the fact there are a number of models you can provide here that really can encourage others to invest in the GPUs than actually the infrastructure to build and developers, such as the role that we play here. And so we have the benefit of that hugely here because, with the miners, you're making a new investment every couple of years here. I think with the GPUs, you may have to do the same thing. But whether you choose GPU as a service, where you have to actually invest in the GPUs themselves, or whether you leave that to another party here, and you're actually providing what's called powered land or a powered shell, or just some of the support services.
So take you back for a minute. 2017, I just joined Bitfury as CFO. One of the first projects was to create HUD 8, and the simple use case there was we were trying to attract institutional investment, and we had a lot of interest, but people couldn't invest either in the private companies or directly in the Bitcoin mining sector. And HUD 8, was an opportunity to wrap a public company wrapper around a Bitcoin mining project and sell it to institutional investors. And roll on to today, and there's 25, 30 NASDAQ-listed public companies. I guess, Matt, are we going to see a dilution of institutional demand for mining stocks, given not just the number of public mining companies, you've got the ETFs, you've got these balance sheet plays like MicroStrategy and now 21. Where is this going to go over the next couple of years, do you think?
So that's a great question. And historically, before the launch of the ETFs, I think all of our companies traded as Bitcoin proxies because, before the repeal of SAB 121, institutions couldn't directly invest in Bitcoin adjacent stuff. Banks couldn't custody it. So the Bitcoin ETFs freed that up. But prior to that, publicly traded Bitcoin mining companies were the closest thing to a Bitcoin proxy. Now there's been this evolution away from a pure play Bitcoin mining facility or Bitcoin mining company. And we think that's a differentiator for CleanSpark. And certainly don't dispute the business models of any of my peers. I think they all have value. We plan to remain focused on what we do best because of the fact that we do have that single focus. The feedback that we've received is that we are really the last man standing in the space. That's evidenced by the fact that 2 years ago we were 12% institutionally held. Today that's 70%. So there's been some erosion of the share price, but that's largely been the exodus of retail investors from our space chasing more of the Bitcoin treasury type companies. So you've got the hybrid HPC AI Bitcoin mining companies. You've got the companies that have completely left the space and have pivoted directly to AI. You've got the Bitcoin treasury companies, and then you've got a pure play. And we're different from everybody, speaking only of CleanSpark, but we hold $1.25 billion worth of Bitcoin on our balance sheet. And unlike anybody else in the space, we mined every one of those at $20,000 or $30,000 a piece. We've now reached the point where we've achieved exit velocity, and by that I mean we're producing 700 Bitcoin a month, and that enables us to selectively sell 2 or 3 or 400 Bitcoin to cover all of our OPEX. So we're no longer a constant dilution machine. In fact, we don't have an open equity offering and haven't for half a year now. So it's just a different approach. And the feedback that I got from one of the bondholders that invested in a $650 million 0% coupon bond that we did in December was that this is indicative of the maturation of the space and is the first step in attracting legitimate institutional capital, because 70% institutionally held sounds really great, but when you realize we were just added to the S&P 600, a lot of that is index funds and other types. It's not fundamental institutional investment. So we see the maturation of the industry starting to favor a focused pure play.
And to Matt's point, actually, we are also seeing a lot greater interest in the institutional side. The industry is maturing here, and you've got a situation now where it's sort of stabilizing. You've got some key players, including CleanSpark here, which attract institutional interest. About a year and a half ago, we actually met with some portfolio managers of Fidelity. And across the board, their attitude was, we see Bitcoin mining as a trade. They didn't see the long-term fundamental prospects. And now that you're getting some stabilization and maturity in the industry itself here, you are indeed opening the door to institutional investors. We're seeing that immensely now with what we're doing with HPC. Because of the stability of the earnings stream, the higher margins, the consistency, the relatively low valuations, the potential for upside, those are all elements that are bringing much greater attention. And the beauty, of course, of institutions is that they have an 18 to 2-year time horizon versus retail, which can be long-term as lunch, kind of the way some of these guys look at it here. So actually, conversely to your original comment, Jeremy, I think it's garnering a lot more interest in institutional investors. You're seeing it, we're seeing it here. And the early adopters are the ones who are really getting on board and spending a lot of time on this, recognizing there is indeed inherent value, and the game is different than it was just a few short months ago.
Fantastic.
Yeah, I think, having been in the capital markets before, when you think about a space, there's usually your bellwether name. You want the exposure, you're going to pile on, and perhaps Clean might be that name, but then there's always stories where there's value to unlock. If you're doing the work, you want to do the sum of the parts, and you kind of look, and I would argue that, Jeff, your story is that there's value to be unlocked at just, the execution there. So there's, the space, relatively speaking, is, like market cap, even with Bitcoin, it's kind of small. But I think that if there is a stampede of interest coming through, there's not that many doors to go through, right? So you could see a real pop. So that's just my 2 cents there.
Cool. Do we have any questions in the audience? We have a question.
My question is for Matt. It sounds like with regards to your relationships with just communities and municipalities, you have a lot of incoming calls to your Vegas office. So my question is, do you ever make outgoing calls? And if there is pushback for getting involved, what's the main thing you hear?
Yeah, so thank you. That's a terrific question. So Scott Garrison, who's our chief operating officer, coined the phrase the front door approach. So when we meet with communities, Bitcoin mining is notorious for negotiating power contracts that maybe the larger communities were unaware of. And so we've taken this front door approach that, land and expand. We arrive in one city, we start to network and work with other cities, and it's generally wide open. Now, there was news a couple of weeks ago about Mountain Cities, Tennessee. And what happened is Scott Garrison, our chief operations officer, was at a planning meeting, and they were talking about power availability under the Tennessee Valley Authority. And he talked about the opportunity to bring jobs and infrastructure and investment into this community. Their prior experience with Bitcoin mining was a Bitcoin miner that operated less efficiently, wasn't very sensitive to the appearance and the noise, some of the consumption, and a number of other issues. So for the first time, CleanSpark got some pushback on the welcome to the community, where historically it's been the inverse of that. And there are towns throughout Georgia. I was talking to Jeff at a prior panel. If I wear a CleanSpark golf shirt and go in to get a burger, they won't let me pay for lunch because of the impact that we've made in the community. So, and that resulted, I think Jeff said, "Hey, can I borrow some shirts?" So,
that was a while ago, I think. If it was ever
But so yeah, there are those occasions that we do encounter some resistance, and we certainly do have outbound inquiries into those communities that make sense logistically from where we're located because, as I mentioned, we build our own repair labs. We do repairs all the way down to the microchip level in these rural communities, and we educate our workforce, so we create these high-tech jobs in areas that the industry and time forgot. So as we kind of share these stories and network, we do have some outbound stuff, but largely it's fed by inbound inquiries. Thanks for the question.
Any more questions from the audience? One more here.
Hi, this is for Jeffrey, relating to the HPC part AI of your operations at Bitfarms. What type of applications does your compute do?
Well, right now, actually, what we're involved in is building out the infrastructure for HPC here. So we're actually in discussions with a number of parties here. And the challenge we really have here at this point is how far do we take the existing infrastructure build out on our own terms versus how much do we hold back as we're working with specific customers, whether it's hyperscalers, tier twos, or enterprises here in terms of what their particular needs are here. So it's not a specific answer in terms of what our computers do here. What we are doing is we're providing the foundational infrastructure to leverage off of that for the GPUs themselves here. That's how we can get the greatest return, the lowest amount of capital that's required here, and really take advantage of our expertise, which is actually the design, development, and build-out of infrastructure.
Okay, well, we're almost out of time. I want to end on perhaps a little bit of fun, if anybody's willing to answer this question. End of this year, do you have a prediction for Bitcoin price and hash rate?
Start with you, Matt.
Views, not linked to your companies, but somebody's got to have one. Come on.
I think there's probably an additional 10 to 15% growth in hash rate just with the nation states becoming more active and the increase in demand we're seeing for Bitcoin. Hash rate shrunk for a while, difficulty went down as the price of Bitcoin was under pressure and energy costs were high and there were political headwinds. Now we're seeing a lot of tailwinds. So I think it's logical to assume that we're going to see an increase in hash rate, albeit slower because 30% of the global hash is comprised of the US publicly traded miners, and all of them have messaged that they don't intend to grow. Funny you should ask about the price of Bitcoin. There's an investment banker that's financed about $15 billion for Bitcoin miners, a friend of everybody in the space, H.C. Wainwright. And I had dinner with Craig last night, and we were kind of taking a straw poll at where Bitcoin would end the year. And the consensus around the table was somewhere between 150 and 250.
Any other views on that?
So from the standpoint of the overall network, we're almost approaching right around about a zettahash. That's about 1,000 exahash at this point. And I think, not in the short term, but in the longer term, you are going to see some of the middle tier miners here, the public miners, who will indeed be sort of not growing their hash rate, similar to us. We're sort of harvesting it now because what we're doing is we're using the cash flow from our mining activities here to really fund our G&A and to fund our debt service as we're building out HPC, and it's working out brilliantly here. But you are going to see a little bit of diminution there. But I do agree entirely with your comment about nation states growing. And I think we are going to be seeing probably around a 20% growth, actually, by the end of the year in terms of network hash rate. As for the pricing, we have a debate about that at work all the time here at Bitfarms. And I would argue I would say about 140 to 170 is where we expect in the year.
Yeah.
I think hash rate's going to be higher. It's not going to grow as fast, but 5 to 10 sounds about right. And I'll split the difference. 150, so we can end the panel there.
I'll give you a different prediction. Is next 12 months we're going to see nation states going public on Bitcoin mining as they realize that stacking Bitcoin is not the issue. It's getting control of the processing, which is the Bitcoin miners, as this whole space continues to develop. So I'll leave you with that thought. But on that, thank you to this wonderful panel. Thank you, guys. And
Thank you.
Thank you.
Enjoy the drinks later.